Welcome, everyone. I am absolutely thrilled to have you here for today's explainer. Look, today we're demystifying one of the most complex, high stakes, and frankly fascinating areas of the whole financial world: options trading. This isn't just your basic high level overview either. We are going to build a comprehensive financial survival guide using the absolute best data out there. So if you've ever felt totally overwhelmed by all the jargon or, the ticking clock of the options market, you are exactly in the right place. Let's get to it. Okay, let's dive into this. Should I trade stocks or options? It's literally the most fundamental fork in the road, right? And it's the absolute most common question new investors ask when they finally start looking beyond their standard retirement accounts. Honestly, the answer completely depends on what you are trying to accomplish, how much time you actually have, and, this is the big one, your honest-to-goodness tolerance for risk. To answer that question safely, here is our roadmap for today. We'll start with a breakdown of stocks versus options. Then, we'll look at the basic building blocks. From there, we'll hit the Greeks and volatility. After that, we'll cover the core of this explainer, the 7 rules for options. Finally, we'll wrap up with surviving the leverage trap. All right, moving right into section 1, stocks versus options. Now, before we can even think about advanced rules, we have to understand the most fascinating difference here, and that is time. Think about it. When you buy a stock, you own a piece of that company forever. Barring a bankruptcy, that stock can just sit there in your brokerage account indefinitely. But an option, it's totally different. An option is a time-limited contract. It is literally a ticking clock that expires on a very specific set date. If your trade isn't profitable by that expiration date, you could lose your entire investment in that contract. So you aren't just betting on the direction a stock will move, you're betting on a tight deadline. That brings us to section 2, the basic building blocks. Let's define exactly what this ticking contract actually is and who the players are on both sides of the table. At its core, an option is just a contractual agreement. Think of it like a firm handshake between a buyer and a seller to either buy or sell an asset at a predetermined price, what we call the strike price, up to a defined expiration date. The buyer is the one who has the right to exercise this contract. The seller, well, they have the hard obligation to fulfill it. And here is the magic number that literally changes everything: 100. Just one standard options contract controls exactly 100 shares of the underlying stock. This right here is where options get all their leverage. You get to control a massive amount of stock for just a fraction of the cost of buying those shares outright. But listen, leverage is a massive double-edged sword, okay? It multiplies your potential gains, absolutely, but it dramatically, and I mean dramatically, multiplies your potential losses too. Let's look at the stark contrast in risk and reward between the two sides of that handshake. Option buyers pay the premium upfront. Their risk is strictly limited to whatever that premium was, but their profit potential, it can be substantial, technically even unlimited. Option sellers, on the flip side, receive that premium upfront, but their profit is capped right there at the premium they collect. Notice the bottom line for sellers, though? Their risk is potentially unlimited. That is a huge, critical distinction you have to understand before you place a single trade. Let's jump into section 3, the Greeks and volatility. If options are a ticking clock, the Greeks are the intricate little gears turning inside. First up is delta. Think of delta as the pure price sensitivity of your contract. It tells you exactly how much your options price is expected to change for every single $1 move in the underlying stock. It's basically your real-time gauge of how your contract is going to react when the stock moves. So the crucial point is theta. Remember that ticking clock we just talked about? Well, theta is that clock. It represents time decay. It's the exact dollar amount your option is going to lose every single day, just by existing, as it gets closer and closer to expiration. For an option buyer, theta is basically a monster in the dark, constantly eating away at your contract's value. And finally, we have Vega. Vega measures market expectations. It shows you how much the options premium will change based on just a 1% shift in implied volatility, which is really just the market's expectation of future turbulence. What's absolutely wild here is that implied volatility can skyrocket or plummet, completely changing your options price, even if the underlying stock hasn't moved a single inch. All right, now we arrive at the absolute climax of our explainer. Section 4, the 7 rules for options. We are taking the most common, devastating trading mistakes and flipping them into actionable rules for your financial survival. Rule number 1, match your strategy to your outlook. Guys, you cannot just guess here. Every single trade needs a directional bias and a specific time frame. You build this outlook using technical analysis, looking at charts, support, resistance, or fundamental analysis, digging into financial statements. Once you actually have that outlook, then you must choose an option strategy specifically designed for that exact scenario. Let's move to Rule 2, which builds right on that. Choose the right expiration date. Don't just pick a date just because the premium happens to be cheap. You have to be honest with yourself and ask, how long do I believe it will actually take for this trade thesis to play out? Like, are you trying to hold through an upcoming earnings announcement? If your expiration date arrives before your thesis proves true, you lose the trade. Simple as that. Rule 3, size your positions correctly. Look, most position sizing errors are born out of pure fear or pure greed. To survive this game, you have to keep those emotions in check. The data strongly suggests risking only a very small percentage of your account value per trade, something like 1 to 3%, or using a very strict, consistent dollar amount. Your trade size should be meaningful, sure, but small enough that you definitely don't lose sleep at night. Rule 4, respect implied volatility. Like we learned with Vega just a minute ago, volatility dictates the price. You absolutely must recognize if an options premium is historically cheap or historically expensive right now. If premiums are cheap, it often makes a ton of sense to look at debit strategies where you're buying options. But if premiums are sky high, you might be way better served by credit strategies where you're actually the ones selling them. Rule 5, calculate your probabilities. Probability doesn't care if you're bullish or bearish. It has zero directional bias. It simply tells you the cold, hard statistical chance of a price hitting a certain level by expiration. It is absolutely essential to sit down, look at the math, and ask yourself, does my statistical risk actually make sense for my potential reward? If the math says no, you simply walk away. You don't make the trade.
Rule 6. Don't just focus on the expiration graph. It is so incredibly easy to pull up a chart, look at what your profit might be on expiration day, and just cross your fingers. But you need to manage your risk actively. Use profit and loss calculators to see exactly how your position is going to react to price movements today or tomorrow. Honestly, if you've already captured most of your potential profit early on, it might not be worth risking the whole shebang just to squeeze out a few more pennies by expiration day.
And finally, Rule 7, always have a trading plan. Having a plan removes emotional decision-making from the equation. A sound plan defines exactly how much you are willing to risk, how you'll find opportunities, exactly when you will enter, and critically, what your exit strategy is. You need a repeatable process. Without a solid plan, it's pretty much impossible to analyze your mistakes and actually get better. This brings us to our final section, surviving the leverage trap. We need to talk about the stark reality of capital drawdown and what is truly at stake when you trade these instruments. Imagine you have a standard $5,000 beginner account. You decide to buy 3 Apple calls for $1.50. Remember our 100 multiplier, that's $1.50 times 100 shares times 3 contracts. So your total outlay is $450. Then you add in a Tesla spread, an SPY put, and maybe a Microsoft Iron Condor. Suddenly, out of your $5,000 account, you have $3,550 heavily leveraged and fully exposed to the ticking clock of time decay. A few small market moves can wipe out huge chunks of this capital instantly if you aren't managing it with absolute mathematical precision. And this brilliantly illustrates the gravity of what we're discussing. Take a look at this direct quote straight from a Securities and Exchange Commission investor bulletin. Options carry no guarantees, and investors should be aware that it is possible to lose all of your initial investment. And remember what we said earlier? For sellers, sometimes you can lose even more. It is a really sobering reality check. You aren't just buying and holding a stock forever. You are holding a decaying contract. Which leaves us with one final, absolutely critical thought to ponder. Knowing the intense leverage involved, the relentless time decay of theta, and the strict adherence required to follow those 7 rules, is your risk tolerance and discipline truly ready for the ticking clock of options trading? It's an incredibly powerful financial tool, but it's one that demands your absolute respect. Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and I'll see you in the next one.